coming into first notice day, there's roughly just over 200 million ounces of open interest for March still there. We don't know what's going to stand. We won't know till Friday, but I think the inventory is 103 million ounces. And what's happened over the last, call it at least 2 years now, is that every single month, whatever first notice day shows for standing for delivery, by the end of the month, it's larger than what starts. That didn't used to be the case. There used to be, let's say there was 100 ounces standing for delivery. By the end of the month, there might be only 6 or 7 ounces that actually stood for delivery. Everyone else took money and ran. Now, if there's 100 ounces standing for delivery first notice day, you might see 150 or 200 or more ounces by the end of the month. And that's the danger, I think, with this next delivery month. There's only 103 million ounces registered deliverable. Now, can they get more? Yeah. Where's it going to come from? I have no idea. But if you have January was over 30 million, and that's not a delivery month. Normally that's like 1 million, 2 million ounces. This month of February, we're over 25 million. That's another non-delivery month. March is a delivery month. If you get anything standing initially close to 100 million ounces, look out, because that's blood in the water for the sharks to go after. In my opinion, seasonals are not as important as they once were. And that's simply because you have China and you have India demanding huge, well, the whole world demanding huge amounts of physical metal. And the problem with LBMA and the problem with CME is they cannot print or mint non-existent silver. That's the problem. I think what you're watching are the physical markets taking over from the future markets. In other words, the dog is finally going to wag its own tail rather than the tail wagging the dog.
Word doc that I sent you comes from Matt Watson, who's an independent analyst, friend of mine. And what that shows you is what the ongoing supply deficit looks like for silver over the next 2 decades. And what we see is everything above that red line is got to be taken from above ground inventory. Well, you don't have to be a rocket scientist to see that you don't have to go out too many years and you've basically, at least in theory, eaten up the entire above ground silver supply. Those are all facts. Now, whether he's got the exact amount of solar need in the year 2030 or not, I don't know, but it's a good educated guess. Same thing with brazing, same thing. The only place I really disagree with him, and I think Bill would agree with me, is that the gray or the silver bars at the very top are investment demand. And he has that as a robust 200 million ounces annually and never increasing any years going forward. I disagree. I mean, you look at how the ETF in India and you look at what Shanghai's doing, I think those bars are going to be much higher than what he forecasts going forward. So what I'm implying here is that the amount of silver above ground that would have to be met for all demand, physical demand for industry, physical demand for investment, will, in theory, run out a lot sooner than what it shows on this chart. So you can't be more bullish than just looking at this fact alone. And at the top, it says silver demand low case. He had a case that shows even greater demand in the higher case, which I didn't want to show. I wanted to remain conservative on what I pretty much could prove. Now, we could go on. The only place that you might really push back is where I did. Investment demand will be weak, or what he shows. I disagree. And you can make an argument. There's some guys out there saying solar will be replaced with graphene or copper. It's possible, but really not very probable. So, I mean, this is all you need to see. I've shown this a couple of hedge fund managers that have decided that gold only isn't the way to go. They wanted to put silver into the portfolio.
Bill Holter and David Morgan say silver at $90 feels different sentiment neutral now versus euphoric in January. Bottom is in. 20-year deficit shows above ground silver gets eaten up soon. Mexico cartel crisis threatens 25% of supply. Miners signaling higher prices. COMEX March could be a bloodbath.
If money supply is growing, what's the number? 5%, 7%, 9%, whatever the number is, that far outstrips the mine supply that's growing, what, between 1 and 2%. And at this point, we've pretty much peaked out. So just from a nuts and bolts standpoint, the more money they create, stuff will cost. When I say stuff, anything, a cup of coffee, an ounce of silver, an ounce of gold, whatever, over time, inflation is built into the system because they have to increase money supply. They have to increase debt because the system is a Ponzi scheme. There has to be more new capital coming into the system day after day after day. That cannot cease. Finally, the shares had lagged for quite a while. So the shares have been behind.
Yeah. And you look at sentiment. Sentiment is, we've moved up to new all-time highs, but you saw we were in the red in sentiment back about a month ago at the same price level. Today, we're back in the blue. Sentiment's kind of cooled off despite the same price level. So, I mean, what dangers does this crisis in Mexico pose to silver, as well as the mining sector as well?
Really, if you're objective and you're not, biased towards, metalheads or resource investors or people that talk about inflation and reality, just on a pure earnings basis, the gold and silver stocks are your value plays. These are value investments. These stocks are selling at relationships to the gold and silver price that are far lower than the real world. You're looking at, round numbers, $30, $35 silver when we're at 90, triple that price. You're looking at round numbers, maybe $3,000 gold, and we're at $5,200 gold. And so we're going to see these earnings continue to increase, and Wall Street is going to pay attention sooner or later. The Druckenmillers and some of the real savvies are already in this space, but the Johnny-come-latelys, the follow the leader types, they will come into this market. And really, remember, the ETFs were started so that stock investors could buy a commodity, because Section 7 people cannot buy commodities for their clients. So ETFs were created. That's where the GLD was the first one, and the SLV was not far behind. But now, if do you want the golden goose or do you want the golden egg? If you want the egg, buy the ETF. If you want the golden goose, buy the mining companies. You're buying them at a discount. You're buying that goose for half price, so to speak. It's going to keep laying more gold eggs and more gold eggs. Why not take part of that? I'm selling my book. I do specialize in resource stocks, not just gold and silver. But let me tell you, there aren't too many clients I have that are unhappy right now. But I did an analysis back, 15 years ago. What I do know is the price was $17 the ounce. But the true cost, not the cash cost, which is kind of BS, but the true all-in sustaining cost was 17. So they were mining silver at a high grade, but they weren't making any money. Why? Because in the United States, you have workman's comp, insurance, healthcare benefits, dental care benefits, pension plan. I mean, of all these things for a U.S. worker that you don't have in Argentina or Mexico. So that puts it, I'm really trying to emphasize what Eric said. Now, if you get let's say a living wage out of the mining industry and you're selling silver at $90 and you've got real earnings, now you have a margin where you can pay American wages and get metal and bring it to the fore. So I think it's a good thing. I'm not for inflation, but I'm for real wages in the real world. And honestly, I think the working conditions should be better than they are in most countries. I'll just digress for a moment more, but I've been in Argentina and I feel for those guys. I mean, they're away from their family 6 months, living in tents, working 12-hour days, and they don't get very good food either. I mean, that's kind of, that's the deal about the mining industry. I mean, it gives you a real look at how the other half or most of the world lives. So maybe I went too far on a rant, but honestly, yeah, I think it helps the whole industry if we have wide margins that are reasonable. you know, and if silver decides it's $200 an ounce, so be it. Let the market decide. As Bill said, let's hit this dog wagging the tail for a change and see what happens in the industry, from the miners to the explorers to the exchanges and everything else.
I mean, it has to, like David said, it has to do with margins. I mean, if the margin's not there, then you're not going to get the exploration. You're not, I mean, that's, the mining industry was starved for a full decade, more than a full decade. And very little exploration was done. There were no big elephant mines found. And I mean, it goes directly back to supply. I mean, if you're not drilling for it, how are you going to produce more in the future? But now there are margins. Now you will have mines or companies, drilling their properties out. I mean, a perfect example is the company my biggest position is TRX, Jim's company. They didn't have the cash flow to drill out the full property. They only drilled out maybe a third of it. Now they've got cash flow. Now they're going to be able to drill. Now we're going to find out. I mean, the reason I bought in to begin with was because of the property. I believed, after looking at the geology, looking at the 43101, I believe they've got much, much more metal in the ground, but we would never know if they didn't have the cash flow to drill. But now they have the cash flow to drill. The thing about the mining industry, it's not like oil and gas. You don't poke a hole in the ground and within 60 to 90 days, you have production. The way it works in the mining industry, you put drills in the ground today, you're going to be totally lucky if you pull 1 ounce out within 3 years. You're looking at a 3 to 5 year time frame or longer from finding metal to being able to produce that metal, produce it efficiently. Silver is affordable to the average person. And that's why silver will again become money when the elephant in the room, which nobody's really talking about, derivatives, they're going to blow up. And when derivatives blow up, you're going to have capital from everywhere trying to fit through a garden hose to get into gold, to get into silver. So I think, we've turned the corner in both gold and silver, but if you look at the two charts, gold's consolidation, it was a high level consolidation. And I mean, here we are, 3 weeks, 3.5, 4 weeks after the fact, and gold's right back to where it was, and silver's on its way.
Markets look ahead, Danny. So it's already factoring, if you believe that, and I tend to agree with that statement. So it's looking ahead, and it's already factored in the fact that we're going to have higher oil prices and still going. That's how I look at it.
Understood. I know you have some other charts here you want to share, Dave. Do you want to go through some of them?
Yeah, let's look at the commitment of traders. I think it's the first one I showed you.
All right, here it is.
So it shows that we only want to look at the commercial side. So it's from February 17th. So that's the last one I could get. And if you look at the commercial, there's one side that says long, one side that says short. On the short side, there's 79,076, and on the long side, 36,729. So I have to do round numbers. 79,000 minus, I'll call it 37,000. And what do we get? 42,000 net long. That's net short. So the banks are net short 42,000 contracts right now. And that's low. Usually they're in the 50 range, minimum 55. It's been much higher. So the point I don't want to make is exactly what the net short position is, but that's how you calculate it. But that there's been people talking about the banks have become net long. And that just simply isn't true. The banks are on the COMEX, net short 42,000 contracts. So that was point number one. We want to look at the stockpiles one in graphic form.
Can you hear me, Danny?
Yep, we hear you. Yep. Is this the one, Dave?
Yeah. And
Sorry
that
about
one's
that,
just
guys. I told you it was my third interview today, and I forgot to plug my laptop in.
okay.
No
So
worries.
going to the COMEX warehouse stocks here, you can see that that chart goes from 2021 till basically present day. And looking at it, you can see it's kind of flat between the year 2021 up to the year 2025, around 300 million ounces of silver. And then it just shoots almost straight up in January 2025. Well, that was the tariff scare. That was metal, silver metal, moving from London into New York. And it increased it to almost 500 million ounces. And then it leveled off at about that level, a little bit higher. And then it came back off. Now, that, let's call it 200 million ounces that came in early January, the next few months into New York, leveled off, and then it went back out. Some of it went back out into London because there was an arbitrage going the other direction that developed. But a great deal, no one knows the exact amount. Well, somebody does, but I don't have the exact numbers. But some fair amount went into the Shanghai Metals Exchange and the Shanghai Futures Exchange. But if you just look at that move up, across, and down, we're basically at a level that's higher now than it's been for 2021, 2, 3, 4, 5 on average. So what I'm saying is that was, I wouldn't call it an anomaly. It's just explained by metal London and New York, and then out back to New York to London and Shanghai. But the overall amount is basically where it's pretty much trended for the last 1, 2, 3, 4, 5 years. And that's where we're at right now. Now, if Bill's right, and we get an exorbitant stand for delivery on the final day, and it's greater than the registered inventory, it will be interesting to see. And we will find out in a couple of days.
Yeah, Bill, do you have any comments on this, on the silver stock inventory at the COMEX?
Yeah, I do. I mean, you could look at it and say, okay, now it's pulled back to the levels we've been at for the last 5 years. But what you have to look at is what have deliveries been for the last 5 or 6 years. January was over 30 million silver ounces. February is already, 25 million. And in the past, those might be 1 million, 2 million, 3 million at most in a non-delivery month. Non-delivery months now are starting to look what delivery months in the past looked like. And true delivery months now are going to be multiples of what they were in the past. So while the registered inventory, it may be flat compared to what it's been for 5 years, the demand has picked up greatly. So you can't look at just the inventory. You got to look at what's going to pick away at it.